I know it's to be true that the only answer to a debt-laden, aging population is what I refer to as more cowbell. Stimulus. Stimulus is the status quo. That's why you like Bitcoin, because you can sense that stimulus is the status quo, the debasement of currency. It's the only way. Because if GDP growth doesn't grow as fast as debt growth, your income is not covering your payments, right? It's as simple as that. And the only way of juicing GDP growth in that formula is debt. So debt needs to grow. The economy needs to grow fast enough that it pays it off. But now each unit of debt lowers each unit of debt gives you less GDP than it did. So it's now $3 of debt gives you $1 of GDP growth. And it's been going like this.
The United States Federal Reserve is expected to announce another interest rate hike during the next FOMC meeting on December 14. According to recent estimates, the market expects a 50 basis point raise, which would indicate a softening in the central bank's previous approach. On Wednesday, the Federal Reserve released the minutes from its latest meeting. The minutes and statements from Fed members like Vice Chair Lael Brainard also hinted that the next rate hike would be lower than previous ones. During its November 2 meeting, the central bank announced its fourth consecutive 75 basis point hike. But during a follow-up press conference, Fed Chair Jay Powell hinted that the committee might soon begin to slow down its aggressive approach to lowering inflation. The minutes from the meeting reveal that several other Fed policymakers agree with Powell. Here is a statement from the minutes. A number of participants observed that as monetary policy approached a stance that was sufficiently restrictive to achieve the FOMC's goals, it would become appropriate to slow the pace of increase in the target range for the federal funds rate. A substantial majority of participants judged that a slowing in the pace of increase would likely soon be appropriate. Real Vision founder and chief executive officer Raoul is convinced that a significant pivot in the Fed's policy will occur much sooner than expected. He has held this view for a while now, and recent events, including a lower-than-expected inflation and cooling in the labor market, suggest that the macro guru might be right on track. In a recent interview, Powell discusses his macro outlook for 2023 and beyond. While he believes inflation will cause less worry in 2023 and asset prices will skyrocket, he sees a bigger problem on the horizon. This giant problem is no other than the issue of currency debasement and its long-term effects on the financial markets. We will now take you to Raoul Pal's interview. Please take a little time to like this video, subscribe to the channel, and turn on post notifications so you never miss any of our timely updates on the cryptocurrency markets. Also, ensure you drop your comments and observations in the comments section below and check out our other videos. Thanks, enjoy the video.
At some point, if I look at the future and say, I'm going to live in 9 months in the future, is the central bank raising interest rates? There's almost a zero chance.
Really?
Well, because we've already got to the tipping point where inflation is starting to fall. Just the extrapolation of interest rates mean that they will be below the Fed funds rate by about March or April next year. So therefore, and what, the Fed going to go to what, 10%? What's left? Rubble. People rioting in the streets, right? You can't do it. So you've got to the point, you're getting close to the point where the rate of change changes. And in 6 to 9 months' time, the Fed are likely to have stopped and probably cut, because stimulus is the only way the world works.
So they raise rates just to lower them again.
Correct. So they lower the rate of inflation, but then it's like, oh shit, we need to bring up GDP growth, because if not, we all go bust. Right? And we need asset prices to rise because you can't let the collateral go bust. That's what's just happened in crypto. The collateral, the FTT token, the Luna token, all this stuff went bust. End of game. All the leverage gets blown up. So they can't allow that. So if you borrow money to buy a house and the value of your house goes down 50%, you're insolvent.
Only if I want to sell, though. If I don't need to sell, I'm fine.
Yes. That negative equity means that the banks then become massively proactive in not doing any more lending. That was 2008. The collateral went down. So what else do we borrow against? We borrow against our jobs. I.e., you go to the bank or you use a credit card, it's because you've got income, right? You lose that. That's your asset, your income that you generate, right? You can't borrow money. The whole system blows up. You can't pay any of your other debts. In the stock market, in the financial markets, people borrow against bonds and they borrow against stocks and they borrow against all sorts of other elements of wealth. If those things go down too much, then people start asking for their money back because the collateral doesn't cover the loan. And that's the issue that the society faces. So it's at every level here. It can't happen. So if your share price goes down too much, you probably can't borrow money if you're a public company, because people then worry, can you pay them back? If your income goes down, all of this stuff. So therefore, I think that, as I said, this is how the world works, is stimulus now in this particular phase of the world. And therefore, looking out 9 months, the probability is, knowing what we know about debt and demographics, that the central bank has not only stopped raising rates, but is probably easing rates to try and balance out. As you talked about, this is what you want them to do, right? You want them to try and just stop the worst part of the collapse and the worst part of the boom. So they'll be doing that. The probability is that they will also be trying to inject money into the economy because there's no velocity of money because these old people. So that's quantitative easing. What does that do? Asset prices go up again. So all roads lead to asset prices going up over time. It's a trick because they're devaluing the value of the currency. It's a trick. But then you've taken the bet and I've taken the bet, which is like, we like crypto because we think it not only offsets this whole mechanism because it's a fixed asset, but it also is a technology that we think unlocks a whole bunch of other opportunities, and therefore it's valuable. So that becomes a superior bet, and I can't get to a more superior bet, and I've tried, and I've gone through everything. I just wrote a huge, long 160-page article about all of this in Global Macro Investor, and I still can't get to a position where, in this construct of the world, that Bitcoin, Ethereum just don't become even more and more dominant and valuable.
The future Powell paints is gloomy. First, we get a much-needed Fed pivot or another round of money printing. As a result, asset prices skyrocket and everything looks perfect. But the underlying problems, especially currency debasement, remain and continue to fester. Fortunately, that's where Bitcoin and other cryptocurrencies come in handy. Whatever hopefully pleasant surprises next year holds for the crypto markets, we can't get there until this FTX mess completely blows over. In his interview, Powell speaks extensively about the collapse of the crypto exchange and its sister company Alameda Research. Here is Raoul Powell's assessment of the current market situation and the FTX collapse.
I think even last time we talked about, we need to parse out crypto into component parts so people understand, because if not, it feels like this huge clusterfuck going on and nobody knows what it is. Firstly, the central banks are taking liquidity out of the system and have been for a while. That has hit all assets. And so crypto down 75%, much like many technology stocks around down about the same. So that's been going on. That's been putting the market under pressure. At the same time, when you get to the bottom of the liquidity cycle, if you think about it, if you think there's a bunch of people in the street saying, hey, buddy, can you lend me $1? You've only got $5 and there's 10 people asking. Well, 5 people aren't going to get it. And that's what happens to the bottom of the liquidity cycle. Those who really need money don't get it. And they blow up. So in June, we spoke in the aftermath of that. That was basically the blowing up of the liquidity cycle. Suddenly you find out that all of the people who were running leverage in crypto were getting blown up and they couldn't get any money from borrowers or they couldn't get any money, from investors. And so that had this huge ramification. So June was actually worse than now, because pretty much it triggered everything. So June was the actual damage, right? That was basically the nuke button to say leverage and crypto, as we've always talked about, don't go together, right? So that blew up, massive balance sheets, 3 Arrows Capital, all of them. But one of them was hidden and we didn't know, and that was Alameda. We knew they were a massive shop. We knew they were kind of a bit sketchy, but they kind of said it's fine, but they weren't fine. So at that point, they were probably $9 billion in the hole, which is a staggering amount of money. Now, we don't know the exact numbers yet, and we won't do for a long time, but there were a staggering amount of money in the hole. That was papered over by FTX.
When you say papered over, what does that mean?
They gave them FTT tokens, the token that is part of the FTX ecosystem that they control and Alameda control, and then gave them a loan against it. That's what it first appeared, but the plot's thickened a lot since then. But so basically they actually went up under in June. So what we're seeing now is the end of the June thing. And then they gave them cash in exchange for that collateral, but that cash was customer money. Right now, we're in the realms of bad. That's what the story appeared to be, and I have been speaking a few times and said, well, you can kind of understand that if Sam Bankman-Fried is going to lose his entire empire in June, you might be psychologically pushed to do something bad in the hope that maybe you can avert it, right? If the 10% chance is worth it. But I asked the question a while ago, and I did this big Twitter Spaces, like, it is not clear to me that there wasn't systemic fraud in this whole thing to start with. The story is now coming out. It's coming out in waves. And again, nothing is verified here. But it's starting to appear that FTX was just a front for Alameda to capture customer order flow to give them an advantage. It's now becoming clear that FTX and Alameda, because we can now assume they're basically the same entity, which is very bad to have a trading operation that takes advantage of customers. We've also seen that they changed their strategy from being these lower risk traders doing arbitrage, buying one thing, selling another, or very quick trading, to big position takers. And it seems that the Luna debacle was them just providing liquidity all the way, and it blew them up. And they pretended it didn't hurt them. But it seems that Alameda itself had changed what it was doing quite a while ago and was basically a punter. Then there's the confusion of who all these people are, and half of these people don't check out properly. We then hear from the guy who's gone in as CEO, who's now the liquidating CEO. And he's like, I've done Enron, I've done all of these. This is the worst mess I've ever seen. So again, news flow's coming out slowly, but it feels like there was never any proper accounting. That there was never any customer positions that weren't being used by Alameda. Again, not clear yet. That they just pulled everything together, and there was no particular Bitcoin or anything else that you thought you bought on FTX that was being stored for you.
Meanwhile, several crypto investors, including Tesla Chief Executive Officer Elon Musk, have criticized the mainstream media for their poor handling of Sam Bankman-Fried's extremely deplorable acts. This is one of the biggest failures in U.S. journalistic integrity of the 21st century, Musk commented under a Dealbook Twitter post attempting to absolve SBF of his crimes. Last week, the New York Times published a 2,200-word interview with the former FTX chief executive officer. The article was largely criticized for stating that SBF would only offer limited details about the central questions swirling around him. It also noted that the former billionaire was sleeping better and playing video games. On Wednesday, SBF tweeted that he would attend NYT's Dealbook Summit scheduled for November 30. Here's a tweet from the official Dealbook Twitter account. Since Sam Bankman-Fried launched the company FTX, its executives and philanthropic arms spent or pledged hundreds of millions of dollars in political and charitable contributions, consulting fees, investments in media outlets, and real estate. One important fact the tweet leaves out is that the hundreds of millions of dollars SBF spent and pledged he illicitly got from trusting customers. What are your thoughts on the mainstream media's attempts to whitewash the disturbing aspects of the FTX collapse and SBF's role in it? Please leave your comments as well as your thoughts and observations on Raoul Pal's interview in the comments section below. Also, ensure you like this video, subscribe, and turn on post notifications for more videos. Thanks for watching.